Good morning everyone and welcome back to a new week for morning markets here at True Potential. Today we're going to be discussing global equity markets and global bond markets, why they reacted the way they did on Friday and why it relates to global PMIs, that is, recent survey data about the health of the global manufacturing cycle. So we'll begin with global equity markets. You can see on screen that global equities fell across Friday. But you'll also notice that global bond yields actually fell as well. That means bond prices rose whilst equity prices fell. And the reason for this is growth fears. Bond markets are pricing a real slowdown in global growth, but not recession fears. And that's because of the way the bond market reacted, which is yields on longer dated bonds, so those maturing in say 10 years, fell more than those on say 2-year bonds. And it's those 2-year bonds which would typically price recession risk first, and we're not seeing that right now at all. So why did bond markets react the way they did, and why did equity markets react the way they did? Well, on Friday, we had a real suite of PMI survey data for manufacturing industries across the world, beginning in Australia and Japan, and feeding through the European session into the US session later on Friday afternoon. Now, all of these indicators in every country are indicating that there's a global manufacturing recession ongoing. But this has actually been well known for about 6 months. It's just a natural consequence of the global goods boom we had through 2020 and 2021. Prices are normalising and the sector is going through a trough in activity. But what's really important within that data is that they measure employment intentions. So in every country from Australia, Japan, Germany, France and even the US, all published on Friday, every single country's manufacturing sector reported a growth or an increase in employment within that sector. So what we are seeing is a growth fear, not a recession fear. Very unlikely that during a recession, industries would be hiring more staff. So we're just seeing a normalisation, and that's why equity market probably overreacted a little bit and the bond market reacted the way it did. And just as importantly, because most economies are based on services, not manufacturing, the services data that came out largely confirms that. These indicators showed a slowing, but still healthy growth, particularly in the US. And that's what we'd want to see from economies which are largely reliant on demand for services and people working in more services-orientated industries. So we're still constructive on global equities and believe that this is just some normalisation in the recent price pressures we've seen and the upward price pressures for global equities. And the bond market's just reflecting a cooling in both inflation pressures and growth pressures. So still comfortable with the trajectory for global earnings surprises and fairly decent global growth within services. So that's all for today. Please join us tomorrow when we'll update you further. Thank you.